Good evening and welcome to the HKT 2025 Interim Results webcast. In attendance today, we have Ms. Susanna Hui, Group Managing Director, and Mr. Patrick Poon, Chief Financial Officer. We'll start with the presentation, followed by Q&A, and with that, let me turn it to Susanna.
Good evening. Thank you for attending the analyst briefing for HKT 2025 interim results. Let me just start with the first slide. So basically, during the first half, obviously, Hong Kong's economy continued to face challenges with the global trade uncertainties, relatively sluggish domestic demand, which of course led to a lot of slowdown and delays in the enterprise investments as well. But despite these headwinds, HKT turned in a very solid performance, underpinned by our network infrastructure, our continuous innovations, and of course our sustained industry leadership. If you look at the slide here, we can see here that in terms of top line, we delivered a 4% growth, with revenue exceeding $2.2 billion, and with key growth cylinders being enterprise side, representing a 11% year-on-year growth, as well as you can see from the slide, mobile services revenue grow by 5%. And EBITDA therefore reported a 3% improvement, reaching $818 million, with a corresponding 3% growth in terms of the AFF at $328 million for the first 6 months. As a result, the Board of Directors today has declared an interim dividend of 33.8 Hong Kong cents per share. Second slide. With the rapid advances in the AI technology, we have been introducing a lot of the AI tools and applications starting 2 years ago, and we have been able to harness its power to invigorate our consumer and enterprise offerings, as well as on the other side of the equation, reshaping our business workflow. Specifically, what we have done is that we have used AI to serve our customers with agility and intelligence through personalized offerings, curated, improved customer experience, and therefore we see successful in terms of increasing the conversion rate of upselling and cross-selling to our customers. As a result, customers subscribing to 3 or more services in our portfolio was up by 13% during the first 6 months. And on the back office side, we have pushed deeper into our own business workflow in terms of transforming, automating processes, and improving productivity, which led to savings of around 7% across the overall cost base. Next slide is basically our fixed network. Of course, in order to embrace AI for our customers and for ourselves, we have to rely on the architecture, basically the ultra high-speed, low latency fiber architecture. So this slide shows that at our core of the network is basically the backbone with a 100 terabit core backbone network, which is enabled, and set new standard for digital infrastructure, and empowering not only the enterprise side but also consumer side with the foundation for innovation well into the future. So if you look at the consumer side, in terms of speed offered on top of the 2.5 to 10 gig for mainstream users, we have elevated the speed to up to 50 gig for premium users. And more importantly, for the enterprise side, we saw massive demand for high bandwidth requirements for AI, video, cloud computing, and so on. So we have improved from 100 gig up to 800 gig services for our enterprise customers. So the next slide here is to show that this very unique 800 gig services, I think, is the only one available in Hong Kong. And this is specifically designed for the supercomputing era. And therefore, in terms of the services available, we have already basically provided coverage to connect all the data center clusters in Hong Kong, including Zhangguan Nou, Chai Wan, Foshan, Cyberport, Tsuen Wan, Kwai Chung, and so on, supporting the AI-driven workloads and multipath routing with carrier-grade redundancy, which is very important for mission-critical tasks. And of course, we have also connected to the Lok Ma Chau loop area in order to potentially surface the massive GBA data flow in the future. On the wireless side, during the first half, we are continually enhancing our network coverage and performance. In this context, we have extended coverage in terms of building new sites, 40 new sites, both indoor and outdoor, as well as utilizing expanded wave from 400 megahertz to 600 megahertz for 5G advanced capability in order to enhance the very important venues for the mega events. For instance, a new Kai Tak stadium boasting 50,000 capacity. Another important area is, of course, to enhance the 5G capacity along the MTR high traffic stations, which we have done in the first half, and with a target completion date by 2026. So benefiting from this, as well as the utilization of AI for better data and offerings curation, our mobile business added 45,000 new customers during H1, with ARPU expanding further to $193. And in particular, if you look at our 1010 and CSL segments, we have demonstrated significant strength in terms of customer base. We have expanded 4% and reported a sustained low churn rate of 0.7%. Roaming revenue continued to grow in response to the strong resumption of global travel, and also our expansion of different tailored roaming plans, and also introducing value-added insurance coverage and so on. We saw that roaming active roamer penetration to our base increased significantly to 69% now, and roaming net revenue therefore reported a 7% growth in H1, which reached 104% of the pre-pandemic level. And in terms of consumer outbound revenue, it increased by 11%, hitting over 140% of the 2019 level. Looking at the 5G adoption, we continue to see 5G subscribers increase and to almost 1.9 million as at June end, representing a penetration rate of 54% and an increase of year-on-year 21%. We also noted that the active AI users on handset consume 60% more data than non-AI active users. So for the first 6 months, we are offering numerous AI applications as well as general training in order to boost the upgrade cycle as well as driving increased data usage, which hopefully will be driving further services revenue growth in the second half. Turning to fixed broadband, with expanding number of high bandwidth applications, the demand for high-speed, low-latency home broadband solutions remains robust. And we also saw a upsurge in terms of the upgrading cycle to 2.5 gig services, with subscriber base growing by over 140%, contributing to an overall growth in fiber users by 3% to over 1.05 million. And this represents penetration of 70% over our total broadband base of 1.5 million. The next slide shows the Now TV content, basically encompassing not only live sports but also drama and movie series, and including Viu, HBO, Netflix, and the like. Now, I think the highlight for the first 6 months is that we saw a significant increase in terms of the number of OTT customers, which recorded a 17% increase year on year, and therefore contributed to the overall expansion of the Now TV base to almost 1.45 million customers. Now, the star performer, I have to say, for the first 6 months is our enterprise business. Despite the various market headwind evident in the first half, our enterprise revenue performed very solidly, with revenue expanding visibly by 11%. And this is driven by 14% growth in cloud projects, as well as 6% growth in terms of high bandwidth fiber lines. More importantly, we see very healthy pipeline. New project wins for the first 6 months was well over 2.2 billion Hong Kong dollars, made possible by both horizontal solutions and applications across diverse industries, as well as industry-specific vertical solutions. Now, the following few slides show some examples in terms of the contract wins, including in the healthcare sector. For instance, we have recently secured and completed tailored solutions for a Chinese medicine hospital in Hong Kong in terms of digitalized workflow and real-time monitoring of assets and patients. We have also included a AI-powered automated solution for Hong Kong, for another Hong Kong public hospital, using robot system to automate material transportation as well as patient tracking. Another example of industry vertical, including setting up a smart ecosystem for cargo management for a leading logistic customer at the Hong Kong airport, which involves interconnected autonomous driving, electric tractors, robotic usage, and so on. Other examples obviously include usage of AI-driven solutions for utility companies, IoT, and as well as network operating center in terms of providing AI-powered video analytics and so on. So we also have been benefiting from assisting enterprise customers to build resilience and diversity for their tech stack in terms of supply chain, in terms of incorporating dual brand design and solutions. Turning to the next slide, which is the China revenue. Originally, we thought that we would be a little bit concerned in terms of slowdown in the China business, but indeed, during the first half of the year, we saw China revenue actually grow by 13%, in particular powered by our SD-WAN services demand growth, as well as data center take-up by the mainland Chinese entities in support of their Go Hong Kong, Go ASEAN initiatives, with Hong Kong firmly upholding the role of the financial hub, as evident from the recent boom in the capital market, as well as Hong Kong maintaining the role of superconnector, with the mainland enterprises seeing Hong Kong as a gateway to global and regional expansion. So we are still optimistic in terms of growing the China business going forward. Now, for our PCCW Global International business, we continue to make significant strides. For our software-defined network platform, Console Connect, we have launched a white label service to enable other carriers to benefit from the self-procurement capabilities of the platform. On the infrastructure side, we continue to invest in subsea cable, on top of the investment in the Simiwi 6, as well as the Trans-Pacific Route Juno subsea cable, which are on track to be up and running for service, bringing top line and profit contribution in due course. In addition, we recently signed MOU to participate in the development of the Pan-Asia Express cables, as well as the Asia-Africa-Europe cables, AAE2, and which we see significant demand in terms of the Pan-Asia area. We also have partnered with a partner to help extend the LEO satellite coverage along the Belt and Road corridors. Next slide shows our club loyalty platform. So we have continued to expand our digital ecosystem, which continue to serve as a flywheel by offering exclusive services and product to our 4 million members. With the 4 million members, we are able to not just improve customer retention via stronger stronger member engagement, but I think the important point is that we can also see a lot of customer acquisition from the non-HKT base from this club members. Now, during the first half, we have expanded merchandise selection and brand numbers, and more importantly, we are able to showcase clear differentiation to our base by including unique lifestyle experience vouchers, which includes concerts and mega events tickets on our shelves, and also including GBA travel benefits as well. Another new business for us, the telemedicine service, Dr. Go also have started a new chapter in terms of extending consultation to the GBA area and also selected destination in Asia, including the very hot destinations such as Japan, Singapore, Thailand, and so on, available to our HKT roaming and traveling customers. We have also launched a new Dr. Go One Wellness subscription plan for telemedicine for synergistic integration into the insurance ecosystem. And we have also partnership with an insurance company into the enterprise segment for employee benefits, which will help accelerate mass adoption of telemedicine. The next slide is on ESG. We have continued to be focused on sustainability, community engagement, and so on. Volunteer hours rising nearly 80%, and we continue to support in the government's Strive and Rise program. We also contributed to improving digital literacy through ongoing AI workshops, and also participated in anti-fraud detection and education to the community at large. Including other sustainable finance and also energy efficiency initiatives and so on, our efforts have been recognized with an MSCI AA ESG rating for the 5th year. Looking ahead into the coming months of 2025, I think short-term challenges aside, we saw a lot of silver linings in terms of boom in capital market, creating personal wealth effect and improving consumer sentiment. We saw mega events like concerts and football matches currently underway, bringing goodwill and reviving tourism. We saw AI continue to drive enterprise transformation in both public and private sector. And specifically to HKT, the recent enhancement and strengthening of the balance sheet and also the lower HIBOR alleviate the interest outflow. All this help positive growth in terms of the AFF. And of course, just now we talked at length in terms of the advent of AI, how this help our organizational agility, help our competitive differentiation, and sustain industry leadership. So overall, we continue to support Hong Kong's drive to be a leading tech and innovation hub, and we are confident of the business growth and therefore the dividend growth in the second half of the year. And with that positive note, I will pass to Patrick to walk through the financials.
Thank you, Sam.
Patrick.
Let me first recap our key financial lines for the first 6 months 2025. Our AFF continued to deliver a solid growth of 3% year-on-year to $328 million. Both total revenue and service revenue report a 4% growth to $2.22 billion and $2.09 billion respectively. The service revenue growth was driven by the robust demand for our local data service in the enterprise segment, as well as the continued growth in mobile service revenue from higher 5G adoption and also expansion of customer base. Our EBITDA for the period was up by 3% to 818 million, with margin stable at 37%, and our NPAT grew by 4% to 265 million. Now let's go into the segment performance. TSS segment first. From the chart on the right hand side, you can see our local TSS revenue grew by 5% year-on-year, underpinned by the continued growth in local data and broadband revenues. Local data revenue achieved an 11% robust growth, attributable to the continued growing demand for our unique digital transformation solutions, utilizing the latest technologies incorporating 5G, AI, IoT, cybersecurity, and multi-cloud application, etc., across diverse industries in our enterprise segment, and also coupled with a 13% year-on-year growth in the China business. Our broadband service revenue registered another 3% year-on-year growth, driven by the increasing demand for our high-speed, high-bandwidth, ultra-low latency, reliable fiber-to-the-home services. Our 2.0 gig service customer base surged 141% growth year-on-year, spurred by the acceleration adoption of home smart devices and escalating bandwidth requirement from data-intensive activities such as video streaming and online gaming. As a result, local data service report a solid 8% growth year-on-year. Pay TV service remained resilient, with Now OTT customers growing by 17% year-on-year. Overall, local TSS revenue expanded by 5%. Our international business revenue grew steadily by 1% year-on-year, driven by the increased global data revenue and also growing demand for our console connect services. Overall, total TSS revenue increased by 4% to 1.61 billion. TSS EBITDA grew 3% to 567 million, fueled by further operating efficiency improvement. EBITDA margin was stable at 35.3% versus 35.6% for the last year. Now, let's turn to our mobile business. Showing on the chart, you can see mobile service revenue rose consecutively by 5% year-on-year to 537 million, underpinned by a 7% increase in roaming revenue, mainly contributed by an 11% growth in consumer outbound roaming. Secondly, further expansion of our postpaid customer base to 3.48 million, a net gain of 45,000 year-on-year, of which the 5G adoption momentum continued, with 5G base growing by 21%, reaching to 1.89 million, representing more than 54% of total postpaid customer base. And also the higher mobile wholesale revenue and growing demand for our enterprise solutions deploying 5G and IoT technologies. Postpaid exit ARPU was up to 193 Hong Kong dollars. Product sales grew by 3% to 130 million, steered by initial AI features of new handset model, despite generally weak on consumption sentiment. Total mobile EBITDA grew 5% year-on-year to 309 million, with mobile EBITDA margin stable at 46%. Let's have a closer look at our operating efficiency achieved. We attained an overall 4% OPEX savings, down from 257 million to 246 million, with OPEX to revenue ratio improving from 12.1% to 11.1%, reflecting our continuous efforts in streamlining business structures and reshaping business workflows via AI to achieve higher efficiency. This AI-led initiative generate remarkable productivity gain and cost savings for the company. Apart from OPEX, we also keep on exercising cautious control over our CapEx spend. You can see here our total CapEx for the first 6 months was lower to 138 million, representing a 3% year-on-year saving. CapEx to revenue ratio further improved from 6.6% to 6.2%. Mobile CapEx registered a 4% saving to 46 million, reflecting the efficiency gain from the capacity upgrade and network maintenance following the completion of our territory-wide 5G coverage. TSS CapEx was lower by 2% to 84 million, with investments largely to support the growing demand for our integrated fixed mobile solutions for enterprise customers. Next is AFF. The EBITDA down to CapEx lines had just been covered. On the CAC license fee, which dropped by 4% to 88 million, mainly due to lower CAC as a result of improved sales channel efficiency. Payment for right-of-use asset also edged down by 3%. These savings were partly offset by the higher fulfillment costs to support our growing base of consumer and enterprise customers. Operating AFF before tax net finance costs grew notably by 8% year-on-year to 468 million. Benefiting from the lower cost of finance linked to HIBOR and also the successful deleveraging done last year, payment for finance costs decreased by 14% to 98 million. Tax payment were stable at 25 million, together with the additions of working capital requirement to mainly finance the enterprise project delivery, which bring positive net cash flow up upon completion. Overall, AFF for the first 6 months 2025 grew 3% year-on-year to $328 million, translating into an interim distribution of 33.8 Hong Kong cents per SSU. Income statement. For the P&L, we have covered from revenue to EBITDA lines. Depreciation and amortization slightly increased to 354 million, of which depreciation decreased, reflecting our continued effort in managing down CapEx in recent years, but amortization increased attributable to higher fulfillment costs incurred for the enterprise projects. And explained, our P&L costs decreased significantly by 19% to 113 million, driven by lower market interest rate coupled with reduction in borrowings. Income tax expense increased to 53 million as a result of higher profit level, with effective tax rate steady at around 15%. Profit for the period increased by 15% to 295 million. The NPAT attributable to the SSU holders grew by 4% to $265 million after the sharing of MI. Turning to our gearing position, our total gross debt at the end of June was 5.57 billion, as compared to 5.94 billion last year. Corresponding gross debt to EBITDA ratio improved to 3.11 times. The lower debt level was due to the successful completion of deleveraging at last year end, and as of today, we have around 2.3 billion total liquidity, including undrawn banking facilities of around 2.05 billion and also 250 million cash on hand. We continue to carry an investment grade rating at BBB or Baa2. Our current proportion of fixed to floating rate debt is approximately 60 to 40, more or less on fixed interest rate to counteract the adverse impact from the interest rate fluctuation. Our effective interest rate dropped below 4% to 3.96%. The average debt maturity is now approximately 3.2 years. No imminent need for refinancing this year. There is a $750 million bond due in July next year, but as mentioned, we have around 2.3 billion liquidity on hand, sufficient enough to redeem the bond when they become mature. And we will keep monitoring the market situation and minimize the interest cost going forward. This ends my presentation. Thank you.
Thank you. We'll open up the floor for questions. The first question is, what is the guidance for interest costs in the second half, given that the impact of lower HIBOR only started in May?
Overall, I think for the first half, we did record a savings in terms of interest cost of around 19%. So assuming there is no significant spike in terms of HIBOR again in Q3 and Q4, we do expect that full year interest savings will be at least 25 to 30%. Thank you.
The next question is, will enterprise growth of 11% be maintained for the full year 2025?
11% maintained for full year 2025. I think overall we have already secured a very significant and healthy pipeline. And given the fact that the recent, and in fact it is in the release of data today, seem to point to a very some recovery in terms of the Hong Kong economy. As I can read it here from this headline, Hong Kong grows fastest since 2023 as spending stabilized. And therefore, I do see that we can be a little bit more optimistic in terms of the enterprise growth, especially with the AI drive. And so I think 10 to 12% is what we will be targeting for full year.
Thank you. The next question is, do you expect the strong roaming revenue growth to be maintained for the remainder of 2025?
Again, I think the answer is positive because if you look at the roaming growth in the past 24 months, the driver is mostly coming from consumer outbound revenue. And for the corporate side, the commercial revenue, commercial roaming revenue, the recovery as compared to 2019 is only 70%. So with the recent pickup in terms of activities in the capital markets, and we have also heard news that some of the iBankers and people from private equity are acquiring property again in Hong Kong. So we will be optimistic that the commercial roaming revenue will also increase. And also with the mega events, with the football and also a lot of the concerts and so on, we do expect that inbound roaming can also improve. And therefore, a very long answer to the question is that yes, we do expect that it will be the growth can be maintained in terms of roaming revenue.
Thank you. Next question is, it's a two-part question. Let me ask the first question first. With HIBOR dropping so low, is it possible for us to further capitalize on this through refinancing into more, I think, floating debt?
I think right now we are 60% fixed, 40% floating right now. So all of these, the 60% are bonds and so on. Obviously, the floating debt benefits very strongly from the low HIBOR because we are basically rolling 1 month HIBOR. So honestly, the rate is below, the cost is below 2%. So obviously, to the extent possible, we would be leveraging on this into more floating, taking advantage of this, but also maintaining the balance in order to be prudent in case there is a sudden spike. And what's the second question?
Yeah, and the second question is around working capital. We noticed that there is some seasonal movement in working capital, and what is the outlook for the second half on that part?
I think this is the part that we would need to manage. Normally, for the first half, working capital requirement would be higher because we have not been able to maybe collect the receivables, and also in terms of completion of the a lot of the enterprise projects, it's all funding required rather than collection. So we do expect that we will be we need to manage, and normally second half working capital would be better. So with that, we are hopeful that that would be positive. Right?
The next question is whether there's any guidance for full year growth in AFF.
Must be better than 3. Does that satisfy? Must be better than 3%. Currently, we are, I think, first half is only 2.7. It's 2.7%, 3%. So with all the positive factors that we have talked about, I am optimistic that we will be better than 3.
That was the final question. Thank you, everybody, and that ends our webcast. Thank you.
Thank you.
Thank you.